Hello, welcome to Pro Trader Strategies Market Commentary for December the 15th. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these daily market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore, what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get this on. A day after the FOMC, they raised rates by a quarter basis points and talked about having three more raises into 2000 or through 2017. Believe it or not, the final one predicted to be in December, as the Fed chair Yellen has become the Grinch that stole Christmas from the retailers. But anyway, having that in mind, they are continuing to do that. If you actually watch that Instagram thank you 2016 video, that real quick short video, I give my expectations for next year. One of those was that the Fed funds rate would be at 1.25, so that's lockstep with what they are planning on right now. I think they are looking at it like a 1% Fed funds rate really isn't going to make a whole lot of difference out there, but it will get the consumer used to increasing interest rates going forward. And the overall equities really slammed down yesterday right after that meeting, but today are rebounding quite nicely to pre-FOMC results levels. Anyway, on to the overall markets. We've got a lot of economic data across the pond in Europe. We've got the French flash manufacturing PMI came in slightly higher than expected at 53.5, expected 51.9. We also got the flash services PMI for the French at 52.6, expected to be 51.8. Remember, these PMI numbers are the purchasing managers index. So it is the people that are buying or gearing up for future activity. So these are one of the more widely looked at economic data points because they're forward looking. They aren't backward looking, kind of like unemployment claims is generally a lagging indicator, if you will. These are more forward looking indicators and therefore are a little bit more widely looked at. So those being above 50 is expansion, being below 50 is contraction. We're seeing expansion basically across the board in all of these. We did get German flash PMI manufacturing side PMI came in at 55.5, was expected to be 54.6, and then the services PMI came in at 53.8, was expected 55.0. So even though that services for the German was slightly lower than expected, still above 50 and showing expansion, just not as robust as they would like to see. And then for the European area, we got manufacturing PMI come in at 54.9, was expected 53.9, and the services PMI came in at 53.1, expected 53.9. We also got Great Britain retail sales came in line with expectations at 0.2%, and then over here in the United States, we've got CPI, which is the Consumer Price Index, and the core CPI came in line with expectations at 0.2%, was expected to be 0.2%. The big surprise on this front was we got a couple of Fed manufacturing indexes. For the Philly Fed, we got the 21.8, was expected to be 9.1, so that was a huge move to the upside. We also got Empire State Manufacturing Index came in at 9, was expected 3.2, so both of those blew the doors off the expectations and really caused the overall equities to start popping to the upside. Then flash manufacturing PMI here in the United States came in line with expectations at 54.2, and then the National Association for Home Builders Market Index, which is kind of like their confidence number, and it's the NAHB, came in at 70 versus 63. So that's been one of the highest readings in quite some time. And then we're waiting for the natural gas storage a little bit later on today. Should be coming out any minute, actually. Anyway, crude oil futures right now coming off a little bit, 72 cents for the most part, still above that $50 a barrel psychological level, but it is selling off a little bit. Gold having a terrible day after the Fed raises rates. That's going to be people pulling money out of gold. It is down $36 on the day. One of those things that I talked about in that Instagram video for forward guidance for 2017 was gold to be at 1,000 by the end of the year. Anyway, on to the bonds. Bonds holding their own, really, down about a half a point right now, 147.30. It did rally up to try and test that went into the 150 handle yesterday right before the FOMC, but then after the interest rates rose, they slammed the bonds. Onto the Dow Jones Industrial Average. It is eyeing up that 20,000 mark that everybody's anticipating probably will happen. The Fed only raising 25 basis points. I said if they didn't raise, it was going to be a sure thing yesterday. It did make a new high right after the Fed released their results, but then came back off. We are testing those highs as we speak. Dow Jones up over 140 points right now. NASDAQ making a new historical high. It seems like we're going to be saying this all the time until I'm blue in the face, I'm sure. But the NASDAQ up 23 points, and it's eyeing its 5,000, which is another milestone mark for the NASDAQ. So, I mean, today's a historical high, but that is going to be a huge milestone for the NASDAQ. E-mini S&P's up almost 13 points, let's call it, and have almost taken back all of the losses seen yesterday after the equities had a mini tantrum on the interest rate rise. And then this is the daily breakdown of the chart. You can see right on the FOMC minute release, we rallied to almost test the highs, and then on that results, it was quite janky, if you will, but got slammed down right into the close for the most part. Today, off this economic data points being better than expected for the most part, with that Philly Fed, the University of Michigan, Philly Fed and Empire State, also that NH8, the National Association of Home Builders Index, all being better here in the United States, has really given a green light for the bulls for the most part, at least for the day. Onto the trades that I've done. Now, you remember I was kind of bearish on gold, wanted to add some short deltas to my portfolio with gold. I didn't have anything on, and with gold, I decided to put on a put spread in there, and I had on the it was a put diagonal that I did for the webinar just a couple of days ago, and wrapped it around my rules for that. And I did it in the February, had bought the 117 puts and then sold the January 107 puts. And originally I paid $6.22 for that, got out of it almost for 50% of my max profit, which would have been right around $3.78, 50% of that max profit, and I collected $8.03 to get out of it. It was about 5 cents off of that 50% mark, but today with the big down day, I decided to pull the plug on that one. Then on to Wells Fargo. Well, as interest rates start to rise, that helps the banks out because it increases their margin on different loans and things of that nature. This is going to help the banking sector. So I had on a synthetic short in Wells Fargo that just was not working out almost from the day that I put it on for the most part. But I decided to pull the ripcord on that and get out of it. I had on the December, I was long the 52 calls and short the 52 puts, and closed that out for or actually the other way around because I was synthetically short. Sorry about that. I was short the December 52 puts and long the 52 calls for that strategy because that's the synthetic short aspect of it. And I originally collected 50 cents for that. It rallied up and had to cover that for $3.94. So that was not a fun trade at all with Wells Fargo. I actually looked to start selling some puts against it yesterday, but then realized that they do have earnings coming up in the next cycle, so that would not have been a very good situation to have because selling short puts with volatility where it is, we would expect volatility to rise going into that event, so I could be directionally correct even if the market rallies and still lose money with the expansion in volatility heading into that binary event. So I just didn't even want to mess around with it. Just wipe the slate clean and get out. One of the trades that I added today was with Bristol Myers and decided to put on some long deltas. The overall medical sector in general, being drug makers, the insurance companies, things of that nature, have really been beaten up lately. So I decided to see, with Bristol Myers kind of breaking out a little bit, throw on some long deltas to add to my portfolio, and went into Bristol Myers, ticker symbol BMI, went into the January, sold the 55 puts for 56 cents. So that's about all I've done for today. Kind of looking for some other opportunities in there, but with the market up so big right now, I'm going to kind of wait and see and play patient right now. Friday, tomorrow, we are going to be doing a webinar on the call calendar, and I'm going to go around all my rules for that. It's great for setup for earnings. For instance, with Bristol Myers, that could be a good strategy to wrap around Bristol Myers as well, because we would expect, again, volatility to expand in that binary month, which is the one that we would be getting long those calls and short the calls right now. So if we thought it was maybe overbought to the upside, we could look to wrap something like that around this type of strategy, and it sets us up for earnings, which is great. All right, so that's all I got for you guys today. Go to protraderstrategies.com, sign up for that webinar, and if you can't take that, take it easy.